Welcome to this special presentation powered by NSE and brought to you by CNBC TV 18. Commemorating the contributions made by the founder of the National Stock Exchange in transforming the landscape of India's capital markets, we are here to honor Dr. H Patil with an exchange of thoughts and insights on the market economy and behavior as part of the Dr. H Patil Memorial Dialogue 2020. As the first order of business, I'd like to invite Mr. Vikram, the MD and CEO of the National Stock Exchange, to deliver his inaugural address. Over to you, Mr. Lima.
Thank you very much. Ladies and gentlemen, a very warm welcome to all of you. The annual Dr. H Patil Memorial event features thought leaders of the highest caliber and reputation as a fitting tribute to the memory of our founding Managing Director, Dr. H Patil, who was one of the tallest leaders and institutional builders of the Indian financial services industry. Over a relatively short period of time, NSE has emerged as not only the largest exchange in India, but also amongst the top 3 exchanges in the world. It is also the largest derivatives exchange in the world in terms of number of contracts traded. Few institutions in India have built a strong global reputation, and NSE is one of them. As an institution of national importance, NSE plays a critical role in working with regulators, government, and market participants in the development of capital markets. NSE has always focused on what is in the best interests of the Indian economy, markets, and investors, and in improving the financial well-being of people. We recognize our responsibility to help India achieve its aspirations and take its rightful place amongst the world's leading economies. NSE owes a deep sense of gratitude to SEBI and the government for putting in place critical market infrastructure institutions that have been responsible for the robust growth of our economy and capital markets over the past 2+ decades. In order to achieve sustainable economic growth, it is critical that we expedite market development and capital formation. While the equity markets in India are relatively well developed, penetration is still low compared to emerging market averages. We need to continue to focus on finding creative ways for investor education and awareness. Unlike equity markets, the bond, currency, and commodity markets in India remain at a nascent stage relative to their potential. It is critical that these markets develop over the next few years for overall development of financial markets that will provide necessary depth in terms of product offerings for investors and capital raising avenues for corporates. Access to capital for SMEs is another important aspect to support growth and employment. NSE is doing its bit by providing an ecosystem for equity and debt financing for SMEs through the NSE Emerge platform for SME IPOs and the bill discounting platform RXIL, a joint venture with SIDBI for providing working capital financing to SMEs. It is important that trust in markets is enhanced and we further integrate the Indian economy and markets into the global ecosystem. NSE is focused on ensuring the highest standards of corporate governance amongst listed corporates, and the integrity of markets is strengthened through regulations and surveillance of market intermediaries and trading activities. We have come a long way over the last 25 years in the evolution of markets and the growth of our economy. The aspirations of our country will continue to be the guiding light as we progress in this journey. As India powers itself forward to becoming a self-reliant nation, we all need to recommit ourselves to creating the right environment and institutional architecture that is conducive for long-term growth and development. We are very fortunate and honored to have with us today Professor Eugene for the Dr. Patil Memorial Event 2020. Professor Eugene, the Robert McCormick Distinguished Service Professor of Finance, was awarded the 2013 Nobel Prize in Economic Sciences for his contributions to the development of the efficient market hypothesis and empirical analysis of asset prices. His work has transformed the way finance is viewed and conducted and has received numerous other awards and recognition for his work. This year's event is being conducted virtually and will be in a discussion format. We're delighted to have with us Mr. Uday Kotak, who needs no introduction. He is the Managing Director and CEO of Kotak Mahindra Bank and one of the most respected and successful personalities in the financial services industry. I'm sure we will all gain valuable insights from the discussion that follows, and I would like to thank you all for participating in this event. Thank you very much.
Thank you very much, Mr. Lima. Indeed, well, the highlight of this special presentation, as Mr. Lima said, it's a conversation between Uday Kotak and Professor Eugene Fama. Just to recap, one is a titan of the Indian banking industry, while the other is a Nobel laureate who is widely recognized as the father of modern finance. Well, their conversation around market efficiency, passive investing and new trends promises to be as elevating as markets themselves during a bull run. So without further ado, it's over to you, Mr. Kotak, for your conversation with Professor Fama.
First of all, a very warm welcome to Professor Fama. Professor Fama, you have really transformed in many ways the financial markets with some of your research. And if I take the liberty of going back to a little bit of your history, I believe when you moved from Tufts to Chicago, you were amongst the first people to use computers. Can you tell all of us, way back and way before anybody else was using computers, would you want to share with how you got fascinated at the computer and the power of computing? I think it was sometime in the 60s.
Right, it was the early 60s, 1962. And they had just installed a computer on campus, and nobody was using it except me and a professor in the physics department. And we had to basically figure out how to make this thing run. I used to call IBM and tell them there was something wrong with the computer, and they would laugh at me. And then after I called them about 3 or 4 times and I was right every time, they didn't laugh at me anymore.
In those days, you were a student, Professor. Is that correct, when you were using the computer for the first time?
Right. That was my second or third year in Chicago.
Yeah, but that highlighted your fascination for mathematics in the business of markets. And if I can then ask, of course, you then went into the building of the whole efficient markets theory. And I understand your neighbor at Chicago, across your office, is another Nobel laureate who focuses on behavioral science and markets. So as a person who's gone and built a whole efficient markets model and the philosophy, how do you respond to behavioral finance? And maybe you want to share something about your neighbor as well in that context, because both of you are from Chicago and completely different perspectives and neighbors.
Right. Well, I tease him all the time and say behavioral finance is really a branch of efficient markets, because all it is, as far as I can tell, is a critique of efficient markets. And without efficient markets, they have nothing to critique. So I always say I'm the most important person in behavioral finance, because without me, they have nobody to pick on.
But Professor, why would you believe that, and which is the core of your conviction? And you've also said that both of you rely on the same facts, but have different interpretations between your efficient markets theory and behavioral finance. So
Right.
Why would you say that based on research, efficient markets is the model versus behavioral finance for markets?
Well, I'll give you an example. So there's lots of evidence that professional managers don't beat the market. And he agrees with that evidence. But from his perspective, what it means is that, like everybody else, professional managers are just dumb. So, but from my perspective, it just means prices adjust to information. So we take the same facts and interpret them differently. That's kind of what happens between us quite a bit. We typically agree on the facts and disagree on the interpretation.
But therefore, Professor, if I take an extension of that, does it mean that you believe discretionary portfolio management is not a smart way for investors to be putting money? They should rather be putting money in index funds because markets are efficient and therefore they will give a better outcome than discretionary fund managers?
A better outcome and a cheaper outcome, because the discretionary or the active people charge way more than the passive people to take your money. So it's not only better, it's also cheaper. But
right.
you need some informed active investors to keep the market efficient. So I agree to that entirely. The problem is most of the professional managers just don't seem to be particularly informed.
In fact, on discretionary fund management, you have used a zero-sum theory. Therefore, if somebody is more weighted in particular stocks versus the index, somebody else is less weighted. Therefore,
Sure.
somebody made more money, somebody's lost more money, and therefore market
Right.
active players will be better off. So a little bit on that, Professor.
Well, that's not a theory. That's arithmetic.
Okay.
For every winner, there's a loser. So it's not a passive people aren't losing because they're just holding the market. It's other active people that are losing to other active people. So that is a zero-sum game before costs. After costs, it's a big negative-sum game.
The core of your theory is prices at any point of time fully reflect all available information. That's the core of your theory, right, Professor?
Exactly.
Okay. So in that context, I wanted to, before I go into some other specific areas, I wanted to talk about a person who was your student, a gentleman called David Booth.
Yes.
And now, of course, he has his name as the Booth School at Chicago. So,
Right.
and he was a big follower of your theory. And then he went out to set up a separate fund management outfit of his own called Dimensional Fund Management, run by David Booth, where you have been very closely involved. So in the initial stages, he was focused much more on small cap and mid cap stocks, as I understand that. So two questions. What made him successful, and how effective is the efficient market theory for small and mid cap stocks, Professor?
Well, I think it's pretty efficient. So the idea is that small stocks and value stocks, so-called value stocks, there are risks that they are subject to that other stocks aren't subject to, and that gives them a different dimension of expected returns. So they started out with small stocks, but then basically moved into value stocks of all size groups now and around the world. So they're much too big to just be a small stock manager at this point.
So, I mean, if you look at the Indian markets and if you look at the National Stock Exchange, they have an index which is known as the Nifty, which is the equivalent of, say, an S&P or the Dow or whatever else comparable you may want in the US context. And today, the most widely traded stock in India is the Nifty, which is the index of 50 stocks, Nifty 50 as it's called. And the amount of volume which happens around that is a justification of your theory of efficient markets. However, if you looked at the amount of money in India which is currently under discretionary portfolio managers versus index, even now most Indian investors are putting money in discretionary into discretionary mutual funds. Therefore, based on your research over the years, would you give them different advice?
I think more could go passive and wouldn't hurt the market at all. The numbers are pretty much the same in the U.S. It's about, when I first started saying this stuff, it took 30 years to go from 0 to 20% passive. And now it's up to 50 plus years have gone by. Now it's up to 50% passive, pretty much the same as in India, I guess. I think it could go a lot higher without doing much harm to the market. We'll see where it goes. Basically, all investors like to think that they can pick the person who will do better, but the evidence says really they can't.
But Professor, at the point which you alluded to, if everybody goes passive, what happens to stocks outside the index?
Well, you got passive in my view includes everything, not just the Nifty 50. So it would be a total market index, not just the Nifty 50. So it's those kinds of things are self-correcting. So if it happens that not enough people are interested in the remaining stocks, then the active people will move over there, and there'll be passive people come along and start smaller stock funds. That should take care of it. I would think that would happen eventually.
Okay. And in your theory, which was, and which you've done for many years, the progress of technology and the increase in rate of information dissemination in today's markets, is that making it even more efficient, or you think that's a lot of noise?
Well, in principle, it should make it more efficient.
Yes.
So better flow of information should make the market more efficient. So I get this question all the time, but the problem is you can't tell whether it's actually happened in the data. The problem is that stock returns are so volatile, it's difficult to detect small improvements in pricing efficiency. So I don't know. We'll need a lot more data to answer that question, maybe 100 more years. I won't be around.
And your view on algorithmic and high-frequency trading in the context of efficient markets for investors?
Right. Nobody, I get that question all the time too. Nobody knows the answer about high-frequency trading. Does it make the market more efficient or less efficient? So that's an open question too. There's just not good empirical evidence on that.
And Professor, the other question which is on minds of every investor, growth investing versus value investing versus a concept of efficient markets. How should investors be thinking about this?
Okay, so that's a good question in the sense that what I said in my Nobel address is there are two pillars of asset pricing. One is efficient markets, prices adjust to information. The other is risk and return. Those are asset pricing models. How do you measure risk? What's the relation between expected return and risk? So the question about small stocks and value stocks is not really about efficient markets. It's really about risk and return. Are these real dimensions of risk that should get compensated in expected returns?
That's interesting. Therefore, if an investor today had to put money, especially in the COVID environment with all that information which is available, should he go for growth or value?
I think you should go with the market.
Or you should go with the market. Okay.
Yeah, I think you start with the market as your the core of your investment, and then if you want to get a little more risky, you might move towards small stocks and value stocks. But generally, I would think that investors who aren't really into all of this stuff and knowledgeable about risk and return should basically stick with the market.
Do you think COVID changes anything in terms of your theory? With the shock you got in March in the world markets versus bounce back, because this was an event of once in 100 years. As I understand, you back tested your model to 1926, which is a little less than 100 years, Professor.
Well, no, there was the first. I don't know what happened in. We don't have the data for that period, but I don't know what happened in there was a big pandemic in
1918.
1918, right? So I don't know what happened to markets at that time. This one was kind of interesting. There was a drop, and then it came back. So markets don't think so far that it's a long-term phenomenon. We'll see, because there's a lot of risk associated with it. The world is not going to look the same when we get done. I don't want to be in the airline business, because I think you're going to see that businesses have figured out that they don't have to travel as much as they were traveling. If you take 2 days of traveling and then go for a 20-minute meeting somewhere, it just doesn't make sense. Now we have this Microsoft Teams and Zoom we can talk as we are right now from thousands of miles away quite nicely. We don't have to get on a plane. So I'm not sure I want to be in the airline business.
Absolutely. Geography is history.
Yeah, right. I like that one.
And therefore, Professor, how would the world change? The economy is a more general question. How do you think financial markets change in the post-COVID world? If you had to just
Change in what sense, though?
I mean, do you see some fundamental structural changes in the behavior of markets?
Well, I don't see any reason to think that. It could happen. I mean, markets are always changing to some extent. So this is a big event, but basically, finance is one of the industries that kept going right through all of this. It just really didn't stop or slow down even.
Mm-hmm.
So there's nothing really to challenge what they've been doing based on the COVID experience.
Moving on to another favorite subject in the minds of investors globally, which is ESG.
Yeah.
Do you think that changes investor behavior and preferences in favor of sustainable technologies? And how do you also, in that context, look at this concentration of investments in a few stocks? And some people, of course, consider it to be potential bubbles. And I know you have a view on bubbles. So how do you look at this change which is happening? One is the whole theme around ESG, which is one question. And the second is, do you believe that few stocks we are seeing huge concentration and reflects a potential bubble?
Well, I'm writing a paper about ESG at the moment. I don't think investors understand that if they tilt their investment towards particular kinds of stocks, whether you think they're environmentally friendly or socially friendly or whatever, if you tilt towards those stocks, what you're going to do is push up their prices and lower their expected returns. So what I say is, virtue is its own reward. Don't also expect that you're going to get high returns from doing that, because the logic of it is that the return should actually be lower. Sin pays better than virtue, basically. So that one, I think that's something that people don't understand very well. Now, the issue really is, are people willing to pay more for products that are produced in an environmentally friendly way? If they are, then that could be a profit maximizing route to take. And are they willing to pay? Well, I know we talked about the willingness to pay more for stocks that are environmentally friendly. I don't think people have talked this through. And the other big issue is, now, how do you evaluate managers in a world where they have ESG goals as well as profitability goals? So you can predict that they're going to say, well, profitability is lousy, but I'm great on ESG, so pay me more. So, and I don't know how those issues will be resolved. My hope is that the two are consistent. That eventually, if people want ESG products, they'll pay more for them, and that will push firms in that direction. So this will all get solved by the markets. We'll see. I don't think regulators, especially in Europe, I don't think regulators are thinking about this very well either.
Therefore, your belief is that the fundamental dichotomy between investors' expectations of returns versus objectives of ESG need to be better thought through for the future.
Absolutely.
And then, Professor, your view about bubbles. People saying that there is a bubble in some of the tech stocks and some categories of stocks in the world as we talk. Your view on that at this point of time?
Not just at this point in time, but at all points in time. Basically, bubbles are things people see with 20/20 hindsight. They don't see them coming, they just see them going. Which means they're not really bubbles, because the whole notion of a bubble is it's something that predictably breaks. But I've never found anybody that can predict when bubbles break. And that means they're probably not bubbles. They're just up and downs in markets. There's a famous old story about this. It goes back to the 1920s. So Holbrook Working, who was a famous agricultural economist at Stanford, he went into his faculty lounge and he showed his economist colleagues a plot. He said, "This is a plot of commodity price. What do you think about these huge up and downs in the numbers?" And they all, to a man, there were no women in those days. to to a man, they said, they could identify the peaks and troughs and put dates on them. And when they got done, he said, well, you know what that really is? That's a series of accumulated random numbers. It's totally random. So that's it. I think that it's hard to top that one even 100 years later.
Professor, one question on time-varying risk. How good is time-varying beta in forecasting asset prices in comparison to constant beta?
So time-varying betas, there's been a lot of work on that, but identifying the time variation in the betas is difficult because of the volatility of stock returns. They surely vary through time. There's no doubt about that. The problem is there's not much evidence that beta is related to average returns. That's the fundamental problem. The original capital asset pricing model has never done very well in the data. Doesn't seem to be much of a relation between beta and average returns. So whether or not you can measure time-varying betas or not, the issue is really moot if they don't tell you anything about expected returns.
Right. Professor, moving to another item in another aspect of financial markets, which is the fixed income markets. And of course, within the fixed income markets, there are pockets which are liquid and pockets which are less liquid. How effectively does the efficient markets theory work for the fixed income markets?
Yeah. Well, in the areas where we have pretty good data, which is basically government bonds, because those trade a lot, it looks pretty good. I mean, it's a much easier problem than valuing a bond is a much easier problem than valuing a stock, because the cash flow is predictable, at least for government bonds, high-grade government bonds. The cash flow is predictable. So you're really just talking about what's happening to interest rates. It's a much easier problem than you're faced with stocks, where the cash flows are also highly uncertain. So I think the bond market is really good. We don't have much interest in the bond market because, as you say, the interesting end would be the corporate end, and that end is pretty illiquid. You just don't get a lot of good prices there.
I see. So corporate end of the bond markets is more difficult to fit into the broad thesis which you're building because of lack of information or liquidity, or what is it?
Well, the reason there's lack of information there is because of the lack of liquidity. Most corporate bonds just don't trade. People buy them and hold them.
Okay. Based on the ongoing research on markets and finance, what are some of the path-breaking concepts, ideas you see which could alter the financial markets into the future? We want to have your mind peek into the future for us.
Yeah, well, I've never been able to do that. People always ask me where I'm going to be 5 years from now. And I just never know, because the world changes, my interests change, and stuff evolves very slowly through time. So I don't have an answer to that question. I know if I look back to when I started, there were basically maybe 10 people in the whole world who were concerned about doing academic research in finance. And now there are literally thousands of people everywhere doing research in finance. So it's very difficult to say where it will be in a couple of years, never mind 5 or 10 years.
Moving a little bit to emerging markets, including India, Professor, what are some of the critical aspects from a policy and regulatory standpoint that are crucial for evolution of financial markets in emerging markets like India?
Well, I think having good available information is important. How information gets out into the public, and having it get out to the public in a way that doesn't advantage insiders is important. So I think you have to look very carefully at insider trading and things like that, and the information process itself, and the market process. But emerging markets tend to be pretty good on the actual trading mechanisms that they have, because they are emerging. They're able to adopt more modern techniques of trading pretty quickly. or even initially when they first come online.
Okay.
Not worried about that part. I'm more worried about the information part. So volatility in emerging markets is really high.
Right. So, Professor, if, in many aspects of the human development, the machine has got the better of human beings. If you look at the game of chess, the machine now beats the human being hands down. Therefore, if I asked you as, again, a peek into the future, with the amount of computing power and AI and analytics which is going on, and the predictability which will come into the models, would you think in future machines will beat humans in terms of returns from markets?
So I've been getting this question for at least 40 years now. So there was a period back in the 70s when people in physics were having a tough time getting jobs. So they thought working in the stock market would be easy for them because they were so good with data. And it didn't work out. It just didn't work out. They were supposed to come up with these artificial intelligence models. Now that's making a big comeback now, artificial intelligence. But we'll see where it ends up. See, I just don't think the patterns that artificial intelligence would uncover are actually there. I think that's the basic problem. If the markets are efficient, they adjust in ways that look random to new information. So there's nothing systematic to be pulled out of it. But we'll see. We'll see.
Professor, one last question before we end. Have you been to India and ever before?
No, I've had many Indian students, always excellent students, but I've never been there. I don't travel very well. I haven't been to many places outside of Europe. We lived 2 years in Europe.
Okay. Let me just tell you that India has extremely efficient equity markets. And as Mr. Vikram Lima, the managing director of the NSE, said, we now have probably amongst the top 2 or 3 countries in the world in terms of the level of volumes which India does on its equity markets on a daily basis. And it is quite a fascinating development, as is said, that Indian equity markets have much greater liquidity than many other aspects of the financial markets. So on behalf of all of us in India, I just wanted to say thank you for doing this interview. And now I will hand it back to CNBC TV 18 to take this forward.
Well, that's your highlight of the H Patil Memorial Dialogue 2020, a conversation between two titans, one a titan of the banking industry and, of course, one the father of modern finance. It's been a wide-ranging discussion, and it's involved aspects on passive investing, efficient markets. And speaking of efficient markets, Mr. Kotak, just to get your view, looking at the global macroeconomic situation and the fact that some people think there's a disconnect between what the markets are going through and what's the actual ground reality. What's your view of this situation that we are in right now? Are markets truly efficient in your view?
No, my sense is that there are many underlying trends which are being factored into by equity markets. Number one, I think what is happening is the significant reduction in interest rates are basically making the core discount rate much lower, and therefore asset prices adjusting to a lower discount rate, which is reflecting in the value of the assets, particularly in the case of equity markets. So that is one factor we need to keep in mind as a part of the overall market reflection. Second is, in general, there is a very large number of companies in the organized sector which have been relatively less impacted compared to companies outside the organized sector, or reflecting in the overall market capitalizations. Therefore, the impact in the economy, which is felt out of COVID, is much more by unorganized sector and smaller companies which don't get reflected into the overall listed space. And along with that, I think a lot of listed companies have become far more efficient and productive, including on costs. But you have to keep in mind, reduction in cost by one person is reduction in somebody else's income. The reduction in income is not reflected in the listed space. The listed space is seeing the more efficient part of the marketplace. And overall, despite that, I think also the fact of the matter is that the economy in the month of October and November is looking much better in India than it did in April and May. And I do hope the way the COVID trend right now in India is playing out is also a positive. Therefore, I think that there's a very big difference between November and April, May, which is what the markets priced it ahead of what happened in the real world, combined with lower interest rates, much greater efficiency and productivity shown by the organized sector, and some of that is getting reflected in the marketplace.
All right, so that's an optimistic assessment. And looking at the source of this up move, Mr. Kotak, my last question to you. Retail investments have been seen as one of the key sources of this up move in global equity markets. What do you think is going to be the impact from a medium to long-term perspective?
I think retail investing, of course, is where investors are now saying that I want to be investors more directly in the markets. And that is a trend which we have seen, especially in recent weeks and months in the world as well as in India. It's a good sign. My only counter alert to investors is that they should be aware of what direct investing means, having a better sense on risk, and combining it with the fact that they must be careful about the leverage which they take, particularly in the derivative space, where the underlying contract has inherent leverage, which comes with its ups and downs. Therefore, I would welcome retail investor participation in the capital formation of the country, that's what capital markets truly provide. But we got to keep in mind that we don't have hubris or excesses which come out of this as well. So obviously, in the presence of Professor Pharma, it would be inappropriate to say that anybody knows what is the level of that exuberance or the bubble kind of thing, because you always find out in retrospect. But I do believe that there is a fundamental increase in financial assets as a source of investing compared to gold or land. And that is a good sign from the point of view of capital formation of India.
All right, exuberance or not, common sense is your best friend. I guess we'll wrap up this conversation between, of course, Mr. Kotak and Professor Pharma. It has been a wonderful conversation. And as someone once said, an investment in knowledge pays the best interest. And I can say this exchange of ideas that you have witnessed could be classified as a multi-bagger. And now to conclude this annual dialogue, I would like to invite Mr. Ravi Varanasi, Chief Business Development Officer at the National Stock Exchange, to deliver the closing address. Over to you, Ravi.
Thanks, Gautam. Good evening, everybody. That's an interesting conversation. It gives me immense pleasure to propose a vote of thanks to each and every one of you for participating in this event. Dr. H Patil, the founding managing director of NSE, was a visionary par excellence who revolutionized the financial markets in India. We're immensely grateful to him for his contributions in building NSE into an iconic institution of global repute. This annual event pays tribute to Dr. Patil, a man with impeccable integrity, strong value system, and extraordinary vision. I thank Professor Pharma for agreeing to be our keynote speaker and participate in the dialogue with Mr. Kotak. We're extremely honored and grateful that you took time from your busy schedule to be with us today. Your rich experience as an avid researcher and educator has provided us with some excellent insights. A special thanks to Mr. Uday Kotak for a very engaging and insightful interaction with Professor Pharma. I thank CNBC 18 for covering today's event. I also thank all the participants for joining us for this webinar. Last but not the least, I thank our colleagues at NSE. An event like this would not have been possible without their enthusiastic support and cooperation. We truly appreciate it. Thank you all once again for being with us this evening. We hope to see you at future events of NSE. Stay healthy, stay safe. Thank you.
All right, that's the closing address from Ravi Varanasi of the NSE. It's been a wonderful exchange of ideas and insights as part of the Dr. H Patil Memorial Dialogue 2020. And we'd like to thank all our viewers for tuning in. Have a good day.